Hi, and welcome to Future Discovery on Download the News. I'm your host, Corties Draper, and on this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today, we're embarking on the deep dive into the historical evolution, corrective use, and current impact of circuit breakers, a critical element shaping the course of futures trade. In this episode, we're delving deep into the fundamentals of circuit breakers. It's not just about numbers on the screen, it's about market stability, protective measures, and the intricate dance of trade halts. To truly grasp the essence of circuit breakers, we must first explore their historical foundations. Daily price limits emerged as the initial line of defense, anchoring futures markets in stability. These limits, unique to each futures contract, act as safeguards, preventing abrupt price swings and maintaining equilibrium. The concept of circuit breakers gained prominence after the stock market crash of 1987, also known as Black Monday. During this historic event, global markets experienced severe downturn, prompting reevaluation of risk management strategies. It was in the aftermath of this crisis that the need of protective measures, such as circuit breakers, became evident. Now, let's venture into the realm of time-based halts, a strategic pause during market storms. Imagine it as a pit stop in a race, offering traders an invaluable opportunity to recalibrate their strategies amidst rapid market movements. Unveiling the intricacies of how these halts are initiated and their impact on market dynamic adds a layer of understanding. But there's more to the story. Circuit breakers operate on tiered levels, responding with varying durations of halts based on the severity of price drops. This sophisticated system orchestrates a measured response to market fluctuations, effectively curbing panic and averting chaos. In the age of interconnected financial markets, collaboration takes center stage. Explore the seamless coordination between futures exchanges and other markets, ensuring a unified and harmonized response to the flow of market conditions. It's a testament to the collaboration efforts that fortify the financial world's stability. Now, let's bring our historical exploration into the present. Circuit breakers remain a fundamental part of global risk management strategies. These mechanisms address extreme market volatility, providing a vital tool for temporary halts to prevent disorderly market conditions. Various exchanges spanning both stock and futures markets globally have implemented circuit breaker mechanisms tailored to their specific markets. The diversity in implementation reflects the nuanced nature of different financial landscapes. For instance, in the United States, major exchanges like the New York Stock Exchange employ market-wide circuit breakers triggered by significant declines in the S&P 500 index. These circuit breakers operate in three stages, each with specific thresholds, offering a collaborative response to market fluctuations. Level 1, at a 7% decline in the S&P 500 triggers a 15-minute trading halt. Level 2, if a decline reaches 13%, another 15-minute trading halt is implemented. And then we have level 3, a 20% decline results in the market closing for the remainder of the trading day. Looking back over the last couple of decades, circuit breakers have played a crucial role during extreme market events. Notably, during the global financial crisis in 2008, these mechanisms served as a stabilizing force. They provided regulators and market participants with the necessary time to assess situations and implement measures to maintain market integrity. While circuit breakers are generally recognized as a valuable tool for managing market volatility, ongoing debates persist regarding their effectiveness in preventing systematic risks. Financial regulators and exchanges engage in periodic reviews and updates on these mechanisms, ensuring they remain adaptive and relevant in the ever-changing landscape of global financial markets. There you have it, a comprehensive journey through the guardrails of the market, circuit breakers. Today, we've not only scratched the surface, but we delve into the historical context, unraveling the intricate threads that weave the protective fabric of the futures market. Continue watching as we speak with Bill Brodsky, currently the chairman of Option Solutions, who has served in various roles throughout the financial industry and played a crucial role in the development and implementation of circuit breakers, particularly in the context of the Chicago Mercantile Exchange. With a career spanning decades, Mr. Brodsky has held leadership positions, including serving as president and CEO of CME Group and as chairman of the board and CEO at Cboe Global Markets for over 20 years. His influence has been instrumental in shaping the trajectory of financial markets. Mr. Brodsky's journey is not just a chronicle of leadership, it is a testament to his foresight and commitment to the market stability. In the aftermath of the infamous Black Monday in 1987, he played a pivotal role in introducing circuit breakers. Bill, thank you for being with us today.
Nice to be with you.
Of course. Can you share your perspective on the significance of circuit breakers in the financial markets, especially considering your influential role in the implementation?
Futures have been trading in Chicago since the 1800s, and futures were traded very differently than stocks and securities in general. And when futures on stock indexes first started trading, the question was, do we have not circuit breakers, but what called price limits? So in agriculture, there were always price limits. Corn, wheat, soybeans could only go up so much in a day. They could only go down so much in a day. Those were called price limits. When stock index futures started trading, we said, you can't have price limits in stock index futures. The stock market doesn't know about price limits, and they don't want price limits. They love to see the market go up, and it goes up without any limit, and it could go down without any limit. And that's how the stock market worked. And that was all lovely until one very dark day in October 19th, 1987, when the stock market went down almost without stopping, down 20% in a day. And that created a major uproar, both in the business community and in the Washington community. Because people in the stock market, they didn't care what was going on at the Mercantile Exchange. They didn't know what stock index futures were. All they knew is that we were somehow messing up the golden cow or the golden calf of the stock market. So there was a terrible negative outcry on October 20th, the day after, saying, you can't, this is unacceptable. You cannot allow stock index futures to be allowed to pull the stock market down. Now, they hadn't even done any studies yet, but what happened is, because futures were so antithetical to the equity markets on Wall Street, they needed to blame someone. And what did they do? They pointed west, and they said, it's all happened. It's all to blame in Chicago. So there were a lot of studies that were done after the big crash of 87. The most important one was called the Brady Report, was done by the former Secretary of the Treasury, Nick Brady. And they did a big study. And the bottom line of the study was, wait a minute, stocks, stock options, and stock futures, it's all one market. You can't say, oh, we trade stocks in New York and we trade them in a vacuum. They're all tied together. And it was not a big surprise to us, but it became important, because then the question is, well, if having the stock market go down 20% in a day is unacceptable, either from a financial point of view or political point of view, what do you do about it? And so there was lots of stuff that went back and forth. And I'll jump ahead by saying that within 12 months of a lot of very unpleasant back and forth with Washington and New York and Chicago, the recommendation that we made came out, and that was, you need to have something that links these markets. The markets were economically linked together, but now you had to do them in a regulatory way, which is not so simple, because the stock market was regulated by the SEC. The futures markets were regulated by the CFTC, and in some respects, never the twain shall meet. So after a lot of negotiation back and forth, and one of the things that was helpful was the fact that I did come from Wall Street, and I knew the leaders of the New York Stock Exchange. So my former boss at the Amex at that time was now president of the New York Stock Exchange. So we were able to really work it out without having a big fight, because there was a potential for a big fight. And we came up with the concept of not price limits, because we didn't want to have a price limit where once you hit that, you stop trading for the day, because the people didn't want to stop trading for the stock market for the day. And we called it circuit breakers. And it meant that if you hit that number, you would take a pause, but after a cooling off period, you could then resume trading. And at first they'd set it to the Dow Jones index, which is really not a good indicator of the stock market. Ultimately, it became tied to the S&P 500. And the history has been pretty good that these things have worked, and they have not. The 20% is a monster number, and happily, it hasn't happened very much at all. So it was an experiment. And it was really a clash of cultures. The culture of the equity markets, the clash of the futures markets was very different. And we found kind of common ground. And I'm very happy to say that not only did the concept work, but it's been adopted all over the world.
I want to know, how did you approach the task of introducing circuit breakers in the futures market? You talked a little bit about how you took on early blame, and you guys were kind of on the hot seat in the beginning. What are some other key challenges that you faced in the beginning of this process of introducing this revolutionary product?
Well, you were dealing with an industry that was separate and apart, the futures industry, and they had for decades, maybe more, the concept of price limits, that if things went too goofy, there was a pause. It was a timeout. The stock market never had that. So all of a sudden, you're introducing a concept from Chicago to New York, and the New Yorkers didn't trust the Chicago guys anyway. So not only was it a lack of trust from one community to another, but it was also a novel concept that you would actually stop trading. The New York Stock Exchange never stopped trading. It might have gotten very goofy, but they didn't stop. Here in Chicago, they'd stop, they'd take a deep breath a little bit. Now, in the price limits, it would come off the limit only if someone wanted to trade at a price which was below the limit. In stock index futures, we had to develop kind of a more customized approach to it, because even with the concept of circuit breakers, the market could not go down more than 20%. So these were very artificial numbers that were put in to kind of, it was a compromise, really more than anything else. It was a compromise. How do you take something that would stop the market and then give people the opportunity to trade again before the day was over? And so again, it went from specific numbers to percentages. It went from one index to another index. So this stuff was modified over time. But the truth of the matter is, I think the last time that circuit breakers were triggered at all was in 2020 during the COVID thing. So we probably haven't even had an incident for 4 years. But the fact that people know that if things were getting really bad, that it can't go to zero. It can go to a certain thing and it's going to stop. And that's probably been a good thing. And I think it really has stood the test of time.
It seems like one of the biggest goals of circuit breakers is to prevent, the panic of selling, going to zero, as you just mentioned. How do you think having these mechanisms set in place helps boost confidence from participants?
I think the fact that it's predictable is the most important thing. And the fact that it's worked and people know about it and it's clear, it's objective, there's no subjectivity to it. I think all those things are important. Markets go down a lot faster than they go up. And so many people in this country have their 401ks and other things in the stock market. You don't want to wake up one morning and find that your account went to zero. So this way there'll be fluctuations, but there's a bottom. And very often when it hits the bottom, the next day it bounces up because there's been that timeout. People gather their facts, they calm down. And very often they'll say, you know what? It was a bad day yesterday, but it was oversold. Now we're going to come in as buyers. Remember, these markets are economically linked. You don't have that with commodities in the same way, because the cash market and the futures markets, although they're linked, it's not as big and as visible in the same way as the stock market.
Do you think that having circuit breakers has changed the outcome during these times of panic, like in the COVID pandemic? To have a better outcome for markets? I know this is opinionated, of course, but do you think it allows for a different outcome or a quicker outcome and speed?
Well, I think what it does is it provides more public confidence. Remember, most of the public doesn't trade in interest rate futures or currency futures or agricultural futures, but many people are somehow connected to the equity markets, and this provides a sense of calm and confidence, which is needed. And not only that, it also deals with the political ramifications, because that was what happened in 87 is basically the political side in Washington said, this is unacceptable. We have to, they could have banned stock index futures completely. So we knew that if we didn't do something really smart and really comprehensive, it could be very bad. So the result has been, I think, a very positive one for all markets in general, but particularly the equity markets.
How do you perceive the global adoption of these type of mechanisms? Do you think there should be more standardization across exchanges in terms of different mechanisms and safeguards?
The U.S. stock market is the largest the most liquid in the world. Stock index futures started in the US. So in many respects, where we are watched as a model by other countries, and each country has its own unique situation. So I think the fact that we've done what we've done, we've experimented, we've had a track record is very helpful. But I know in preparing for this, I found a World Federation of Exchange working paper on global stock circuit breakers. So the nice thing is that there's been a lot of history now and a lot of work done. So it's not that we're in a vacuum and we're only doing it here. It's being done all over. People watch what's happening and they learn from it. I think it's a very positive development.
But have you seen any other cool or innovative, techniques and mechanisms over the years that have helped safeguard the industry, just drawing from your experience?
Probably the most important thing is that once the study of the stock crash of 87 came about, there was a broader recognition that these two markets, which were both very liquid, very powerful, were inextricably linked together. So one of the things that came out, and it took a while after the implementation of circuit breakers, what we call cross-margining. So because again, we had two kind of silos. You had the holy grail of Wall Street, the stock market, and you had these crazies in Chicago doing this thing called stock index futures. And how do you make this all work better together? Because it was the big finding of the Brady report is it's one market. It's not two separate markets that don't talk to each other. It's one market. And so the next important thing we did, and it wasn't easy either, was to create what was called cross-margining. So in stocks, you had the Stock Clearing Corporation, DTCC, and in Chicago, you had the CME Clearinghouse, which cleared all the futures. And then you had the Option Clearing Corp that cleared all the options, so that people, particularly at the CBOE, who had option positions and had countervailing positions on the futures market.
What are some lessons that you've learned throughout your career that have, maybe geared? I know you've probably learned a lot throughout all your years in the industry, but maybe focusing on collaboration. You've been so innovative throughout the years as well. And then, finding compromise. I know those are kind of some broad topics there, but what lessons have you learned, and what can you share with us to our approaches in trying to be innovative and collaborative and innovative in the space?
Well, I think it should be open to new ideas and listen to other people. Certainly in those early days, when it was stock index futures and the stock market, you had two industries that had been around over 100 years. And there weren't a lot of people that could speak both languages. And so bringing people together for the good of the whole community was very important. And the other is the very important role of market leaders in educating both the regulators, but also the policymakers, the members of Congress. So I spent a lot of time in Washington in those days, a lot of time. And I will tell you, start talking about stock index futures and people's eyes would glaze over. And so you had to do a lot of work. What I learned about education, particularly among people who are not involved with markets, it's a process that never ends, because whether it's at the regulators or at the congressional level, people change. There's always new people coming in. So the fact that you did a great job a year ago doesn't mean that the people in those positions today will know what you're talking about. So what I learned is that you can never stop educating the people who have the power to put you out of business.
You have to be able to speak multiple languages. You have to be able to connect with your audience and who you're talking to, and having an understanding of, you have the legal side before the business side that got intermingled as well from your father too. And so being able to speak those languages, being able to be adaptive to different environments, I think has held true to your success over the years. And I think anyone in the industry or looking to get into the industry can really draw from those insights. And so, before we conclude here, kind of going off that as well, what advice would you offer to aspiring individuals like myself looking to make their mark on the industry? What advice do you have for them just starting off and just getting into the space?
Well, one is to work really hard, take whatever job you have and do the very best you can. Not because it's the only job you'll ever have, but the better you do, the more you'll get recognition in it. And I think that the second thing is try to meet other people and learn from other people, from what their lessons are, and be very open-minded. We have a wonderful community here, the community in Chicago that has evolved from the creation of both stock options, financial futures, all these things. There's no community in the world that's more knowledgeable about these markets as the group in Chicago. So there's a lot right in the local community here that people can learn from. But the other thing that we did, and if you're in a position like I was, where I was heading an exchange, is to develop relationships with other places around the world, because people are these issues are not novel to the U.S. They just happen to come here first because all this was created here first.
I think this has been great, Bill, and we appreciate your time and insights into the intricate world of circuit breakers. Your experience and expertise provides valuable perspective as we navigate the complexities of financial futures. Thank you for being a part of Futures Discovery.
And thank you for what you're doing to help educate lots of other people.
Thank you. Thank you.
If you're enjoying the content today on Futures Discovery and want to learn more about derivative markets, look at some other videos on our series, but also check out Options Discovery hosted by Esma to learn more about the space.